You would expect the SpaceX IPO to be a gift for space stocks. $1.3 billion flooded into space ETFs in just 30 days. Rocket Lab is up 72% since the S1 dropped. Intuitive Machines, 67%. But here's what the same S1 actually says. SpaceX is asking public markets to pay 96 times trailing sales for a business losing nearly $5 billion a year. And the space stocks that retail investors are buying to front-run this IPO, they are already trading above these valuations with worse financials and a fraction of the revenue. So the IPO just became a valuation test. But to understand why everyone is chasing space stocks right now, we first have to understand that the bull case is real and not just a fantasy. We are looking at a $630 billion global space economy today that's on track to hit $1.8 trillion by 2035, according to the estimations from the World Economic Forum. This isn't like the early days of the industry, where companies were trading purely on PowerPoint slides. Starlink proved to the entire market that commercial space can work, scale, and earn money. But ever since SpaceX filed its confidential S1 on April the 1st, public space equities went completely vertical. Rocket Lab is up 86% as of today. Intuitive Machines also 82%. If you zoom out over the trailing 12 months, the numbers look unreal. Here, Rocket Lab is up by almost 380%. And Planet Labs, a company that I had on my watchlist for over 2 years already, skyrocketed by over 1,200%. Talking about a missed chance. This isn't just a retail hype either. Space-themed ETFs dragged $1.3 billion of net new money in just 30 days. And in the last 3 months alone, 6 new space ETFs and funds were launched. To put that into perspective, that's the fastest capital inflow that we've seen since the absolute peak of the 2021 SPAC bubble. The logic that is driving this trend is simple and seductive. The thesis is that if the undisputed king of the industry is finally going public, you buy the alternatives now to front-run a massive wave of institutional capital. It feels exactly like buying smaller EVs right before Tesla went public. At first glance, this looks like a completely rational trade. But there is one specific number hidden inside the S1 filings that completely breaks this thesis. Because when SpaceX S1 IPO became official, the market treated it like a pure play listing for Starlink. Retail investors think they are buying a clean, high-margin satellite internet monopoly. They are not. They are buying a sprawling, capital-heavy conglomerate. For fiscal year 2025, SpaceX brought in $18.7 billion in consolidated revenue. But look at the bottom line. The company posted a GAAP net loss of over $4.9 billion. To understand why, we've got to break this business into its 3 distinct segments. First, we have the connectivity, which is Starlink. It's an absolute beast, pulling in $11.4 billion in revenue and generating $4.4 billion in pure operating income. That alone would be a 38.6% operating margin. But this cash engine is subsidizing 2 other segments. Here we also have the space segment. It generated $4 billion in revenue, but lost $657 million on a GAAP basis. Why? Because while the Falcon 9 program prints money, Starship is eating over $3 billion a year in pure R&D costs. And then there is the AI division, which brought in XAI and Grok earlier this year. It added $3.2 billion to the revenue, but burned through $6 billion in operating losses for 2025. To keep their massive AI infrastructure online without imploding, SpaceX even had to sign an agreement with their competitor Anthropic for compute access. It yields $1.5 billion a month, but here's the hidden risk. That contract is completely revocable by either party on just a 90-day notice. So if Anthropic pulls the plug, those multi-billion-dollar compute costs land right back on SpaceX's shoulders. And Starlink's exception operating margins are completely swallowed up by the other 2 segments. At a $1.8 trillion target market cap that they are expecting right now, SpaceX is asking public markets to pay over 90 times trailing sales for a business losing nearly $5 billion a year. And that's the benchmark the sector now has to price against. The question is, what happens to the other companies when institutional investors run the same math? Rocket Lab trades at an EV to sales multiple of 102.2 times. So you are paying a premium to SpaceX itself for a company with only 670 million in annual revenue, no GAAP profit, and a flagship rocket that hasn't even launched yet. Then you have AST SpaceMobile. They are in a different category. 365.8 times trailing sales. The company generated 84.9 million in revenue last year. In Q1 2026 alone, it burned 309.7 million in free cash flow. That's more cash gone in 90 days than the entire year's revenue. The rest doesn't look as bad, but is also not much better. Now, the standard critique here is obvious. These are early stage disruptors. You just can't value them like a boring old industrial company. Yeah, fair enough. So let's run a sanity check against companies that actually make money from space today. Lockheed Martin, for example, brings in $13.3 billion in annual revenue just from its space segment. It operates with positive operating margins and sits on a backlog of $39 billion in its space segment alone. Its valuation? 1.8 times enterprise value to sales. The small cap pure plays are trading at 50 to over 200 times the multiple of the actual profitable operators in the exact same sector. So when SpaceX lists at 96 times, it doesn't tell the market that 365 times is justified. It tells the market exactly what a dominant, scaled and partially profitable space business is worth. Everything above that line, especially with worse financials, has a problem. And by the way, if you appreciate this data-heavy and objective analysis and think that it helps your own investing, hit subscribe. I post 1 to 2 of these videos every single week. And now let's look at how this plays out. Because we've seen the exact same setup before, and history has a pattern on how this ends. When a dominant sector leader goes public, there are often 2 distinct patterns. The first is a selective rising tide. Look at the ARM Holdings IPO in September 2023, for example. It lifted their design peers like Synopsys or Cadence because they share the exact same high-margin, asset-light economics. The second pattern is far more dangerous, and I think that it's exactly what's playing out in the space sector today. Think back on the Coinbase listing in April 2021 or the Rivian IPO in November of the same year. Both triggered a massive short-term euphoria across their industries. Lucid Motors, for example, suddenly surged to $90 billion valuation. Speculative crypto miners went completely vertical. But the second those category leaders started trading publicly and the hype vanished, the structural mechanism flipped and their peers crashed. And the new public benchmark reprices everything smaller against it, and anything that can't justify its multiple against the leader sells off. We already got a preview of this in the space sector just a couple of days ago. On June 1st, a Blue Origin New Glenn rocket suffered a hot fire test explosion. It had absolutely nothing to do with Rocket Lab's operation or AST SpaceMobile satellites. But look at the market's reaction. In a single trading session, Rocket Lab plummeted 12.87% and AST SpaceMobile dropped 9%. That's not a fundamental move. That's pure sector beta. Now, imagine what these high multiple names look like the moment the narrative shifts and reality kicks in. But while most of these names don't survive a direct comparison, there are 2 companies that are different enough so that they are not dependent on SpaceX market halo. Planet Labs, for example, also trades at a premium, but its business is fundamentally different from SpaceX. It operates a high-resolution Earth imaging satellite constellation and sells the data at a subscription to governments, intelligence agencies, and other clients. And more importantly, Planet Labs already turned their cash flow positive last year. The company had a 56% gross margin and generated over $57 million in free cash flow for the last fiscal year. It's self-funding, and its survival doesn't depend on capital markets or the mood of an IPO underwriter. Their revenue is up by 26% year over year, and they have a backlog of 900 million with 98% annual contract value on recurring contracts. They expect to reach GAAP profitability in 12 to 18 months. That's not a certainty, but it's a real forecast, not a projection built on hope. Then we have Viasat, which is pretty much the value baseline for the entire sector. It's easily the cheapest name in the group, trading at just 3.6 times EV to sales and 10 times EV to EBITDA. It's a mature operator, not a speculative startup. Viasat just generated 600 million in annual free cash flow. But here is the real catalyst. Their capex cycle that is currently peaking. And as the capex rolls off, that free cash flow is set to expand significantly. Neither of these two is a momentum trade, but they are the two names with a standalone investment case that holds up whether the IPO lifts the sector or crushes it. LUNR gets an honorable mention, but there is a catch. Its forward EV to sales of 8.7 times looks reasonable and the revenue ramp is real. But the cash runway is just 11 months. That means that the company needs money and might dilute their existing shareholder by issuing new shares. Keep that in mind before investing. So, what's the verdict here? In the 30 days around the IPO, passive inflows, ETF buying, media coverage and the sheer momentum will probably push the whole sector higher. That's already happening as we saw before. 1.3 billion in space ETFs in a single month, that is just crazy. If you bought Rocket Lab or ASTS 6 months ago, you're sitting on very good gains and those gains may continue for a few more weeks. But momentum and investment thesis are not the same thing. And look at the valuations. This isn't fundamental expansion. It's a speculative front-running frenzy that has completely detached from the underlying business execution. So when the IPO closes and SpaceX is public as a benchmark, the question every analyst, every fund manager, and eventually every retail investor will ask is, does this multiple hold up against 18.7 billion in revenue and a company that's actually operationally profitable in its core segment? For Rocket Lab at 102 times EV to sales? No. For ASTS at 365 times, burning 310 million in cash per quarter? Definitely not. Planet Labs and Viasat are standalone cases with their own investment thesis. All the other names need the rising tide to keep rising. And historically speaking, it just doesn't. Intuitive Machines is the wild card. On paper, its forward multiple of 8.7 times looks reasonable. But with an 11-month cash runway, it is also quite risky. But this isn't a call to go out and short these stocks. Shorting a high beta momentum stock is a great way to blow up your account. It's a warning not to mistake a short-term liquidity trade for a long-term investment thesis. But as always, that's just my opinion. So what about you? Are you already invested in any of these space stocks? And do you think that these stocks will keep on going up, or are you about to close the trade? Let me know down in the comments. And if you would like to know why I think that ServiceNow is trading at over 50% discount right now, even though there are some structural headwinds that could destroy their moat, watch this video next. And as always, that's no financial advice. So please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys and see you in the next video.